Hello everyone, I am Sonal Mittal, Product Specialist at UTI Mutual Fund. Welcome to this edition of Fund Insights, where our fund managers take you through the investment frameworks and insights of the fund. Today we have with us Fund Manager Ms. Preethi, who is managing UTI Banking and Financial Services Fund. So here is the first question to you, Preethi. Why should investors consider banking and financial services sector funds?
First of all, Sonal, thank you for having me here. And on your question, as you all know, that banking sector is key to overall economic growth, and it's driven by structural, strong domestic tailwinds on both the loans or credit side and the financialization of the savings. So coming to UTI Banking and Financial Services Fund, it provides exposure to two themes: to businesses beyond banks, which includes NBFCs, insurance, capital marketplace, fintechs, so which have come into the public listed space in the recent past. And it also gives exposure to higher mid-cap and small caps within the BFSI universe, which itself is a large universe of 100 plus companies.
So what is your investment philosophy and approach when it comes to managing UTI Banking and Financial Services Fund?
The fund's investment philosophy is centered on UTI's Score Alpha model. And what is Score Alpha model? We basically rank the companies based on the return ratios over the last 5 years in each segment into R1, R2, and R3. So the highest return ratio companies you'll actually see in R1, and then it follows in R2 and R3. So if you see our core portfolio holdings will be in R1 tier with demonstrated history of consistent growth and as well as these return ratios. And we tactically as well invest into turnaround or cyclical opportunities, which typically feature in R2 and R3 tiers, which have the potential to generate disproportionate returns when the earnings come back, and as well as there is a potential for re-rating as well. And as they graduate to higher tiers, so the history suggests that they have the potential to generate disproportionate returns compared to the market.
Preethi, what factors do you consider when selecting specific companies within the sector for investment?
Typical investee companies outperform the underlying segment on growth and generate superior returns through prudent underwriting practices in lending and as well as demonstrating cost leadership. So these are the companies which fall in R1s. For example, if I had to take for illustrative purpose in banks, HDFC Bank falls in R1 category where they have demonstrated high teen growth over 5 years, 10-year period, and as well as in terms of ROE, they have generated 1.8% ROE over a 5-year period. So those are the typical investing companies. And like I mentioned, we also invest in cyclical or turnaround opportunities where we see the potential for them to move from R2 or R3 to the higher tiers.
Preethi, can you walk me through the current composition of your fund's portfolio in terms of key holdings within the banking and financial services sector?
Right. So given it's a sector fund, the benchmark weights play a key role in determining weights in stocks across segments. So if you see the benchmark, nearly 80% of the benchmark is in banks. And if you see our fund, 60% of exposure is in banks, which means 40% is in non-banks, including NBFCs, capital markets, insurance, and PSU banks. And when we talk from a market capitalization perspective, so nearly 100% of the benchmark is in large caps. But if you see our fund, 30% is in small and mid cap, and the exposure to large cap is at 70%. Thank you for watching this video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.